Hi everybody, and welcome back to my channel. Today we're going to be talking about the PAYE loan, which stands for Pay-As-You-Earn, and it is a student loan repayment plan which is meant to reduce the amount of your monthly payments. So if you haven't watched it already, I would highly recommend that you watch this video right up here about an income-driven repayment plan, because this pay loan is just one option that's available to you in terms of income-driven repayment plans. There are actually 4 different options. And today we're going to be diving deep on the pay program. But if you want to know what all of the options are that are available to you, please check out my other video before watching this one. I'm Melissa Ford. Welcome to Damsel of Success, where we talk about all things money. Please be sure to like and subscribe and hit the bell to be notified when I post a new video. So like I said, today we're going to be talking about pay loans, which stand for Pay As You Earn. And this is just one option that's available under what are called income-driven repayment plans. So what is this pay plan? The first thing that you need to know is that this is a long-term payment program. It's not temporary relief like a deferment or a forbearance. This is different. It's also not a loan rehabilitation program. So if you are currently in default on your student loans, this isn't the kind of program that's right for you just yet. A pay loan can make your student loan monthly payments a lot more affordable because it calculates your payments based on 10% of your discretionary income. And we will get into what discretionary income means in just a bit. So what makes a pay loan so special? Well, on top of the fact that it reduces the amount that you're paying every month for your student loans, but it also has this one really cool thing about it. And that's that if you have continuously paid on your loan over the course of the term of the loan, which in this case is a 20-year-long loan, well, at the end of that term, if you still have a balance remaining on the loan, it is forgiven completely. The federal government says, congratulations, you are done paying this loan. So that forgiveness does come with a little caveat, and that's that if you are forgiven an amount on your loan balance, that amount will be added to your taxable income for that year. So for instance, if you had a $10,000 amount that was forgiven on your loan and you were in a tax bracket where you paid 25% of your income in taxes, well then you would owe in tax $2,500 for that forgiven amount. And that's not super fun, but it is a lot better than paying the full $10,000. Other things that are really great about a pay loan is that, first of all, it's based on 10% of your discretionary income, which is the lowest amount of all of these kind of IDR plans. Second, it is a 20-year loan repayment program, which means that the entire length of the loan will only be 20 years long. And that's the shortest amount of all of the IDR plans. When you're inside of a pay program, another great benefit is that your interest doesn't capitalize, which means that you're not paying interest on your interest. So that loan amount doesn't just like snowball out of control into an amount that is just completely unreasonable. The next great thing about the pay program loan is that it is capped, which means that the maximum amount that you will ever pay on this loan is the exact same amount that you would have paid on a standard student loan. So if, for instance, your student loan payment was $500 under a standard loan repayment plan, well, even if your income adjusts so that your discretionary income is much higher than that, you'll never have to pay more than that $500 amount. Another really great benefit of this plan is that only includes your spouse's income if you file your taxes jointly. Now, that's something that you'll want to consult a tax professional about as to whether or not it makes sense for you and your family. But some of these plans don't even give you the option of whether or not you're allowed to include your spouse's income as your discretionary income. And this one does. So you have that option. So what are some reasons that you might not want to do a pay program loan? Well, like all other IDR loans, it is a longer repayment plan. In this case, it's 20 years long. So instead of a standard loan repayment plan, which would be about 10 or 12 years, this is 20 years. So it's much longer. And because it's much longer, you're also going to pay a lot more interest on that loan. So it'll have double the amount of time to accrue interest, and that makes your total loan amount that you're going to pay ultimately a lot larger. Another thing that you need to be aware of with this loan is that you do need to recertify every year in order to be eligible, and your payment will adjust as your income adjusts. And while there is that great benefit of an amount being forgiven at the end of that 20 years, chances are actually pretty good that you're going to pay off that loan before any amount is forgiven. And if you do have an amount that's forgiven, well, like I already said, you will be taxed on that forgiven amount. And another thing that's a little bit of a disadvantage about these pay loans is that the eligibility requirements are actually pretty high. It's one of the more strict programs that you have to qualify for in order to be eligible. So let's talk about what those eligibility requirements actually are. So in order to be eligible for a pay loan, or really any IDR loan, you have to have two criteria that you meet. Number one, your loan has to be a federally backed loan. A private loan is not eligible for a pay loan or any other IDR loan. Second, you also have to be current in your payments. You can't be in default. If you're in default, you have to get yourself out of default before you'd be eligible for a pay program or any IDR program. Now, on top of those two requirements, the pay program has additional requirements that you have to meet. First of all, you have to be what is considered a new borrower. Now, being a new borrower is a very specific term when it comes to this loan. So to be considered a new borrower, you have to meet two different criteria. Number one, you can't owe any money on any student loan prior to October 1st of 2007. Second, you have to have received a loan disbursement on or after October 1st, 2011. Now, I don't know why those are the requirements for being considered a new borrower, but they are. So in order to qualify for the pay program, you must meet both of those requirements. Another condition of the pay loan program is that you have to be able to demonstrate partial financial hardship. And what that means is that you have to demonstrate that under your standard loan repayment program, the amount of your monthly payment exceeds 10% of your discretionary income. And we will talk in a minute about how your discretionary income is calculated. But just keep in mind that in order to meet that guideline of partial financial hardship, you have to demonstrate that your standard student loan repayment is more than 10% of your discretionary income. And the last criteria that you have to meet in order to be eligible for the pay loan program is that your loan must be a direct loan. And we will get into that and what it means in just a second. So first of all, let's talk about what that discretionary income means. So a discretionary income is calculated based on what your AGI is, which stands for adjusted gross income. And you can find that AGI if you filed a tax return on page 1, line 11 of your 1040. The AGI is basically saying this is what your taxable amount of income was, taking into account things like your taxes that you pay on your income, your 401k contributions if you make them, and last but not least, any healthcare costs that you're paying pre-tax. So if you have health insurance through your employer and your monthly payments are deducted from your paycheck before your taxes, that takes away from your total adjusted gross income. Now, once you have your AGI, then you can calculate your discretionary income based off of that. So for the purposes of the pay loan, your discretionary income is what is left after you subtract 150% of the federal poverty line for your state from your adjusted gross income. And I will give you a full demonstration of what that means in a little bit here. But first, I want you to take a look at what kinds of loans are eligible under the pay program. And I'm going to put up a nice little chart here so that you can see specifically if your loan qualifies. So eligible loans include direct subsidized loans, direct unsubsidized loans, direct plus loans made to graduate or professional students, and direct consolidation loans that did not repay any plus loans made to parents. If you were to consolidate one of the following loans, they would also be eligible. So you're looking at subsidized federal Stafford loans from the FFEL program, unsubsidized federal Stafford loans also from that FFEL program, FFEL plus loans made to graduate or professional students, or FFEL consolidation loans that did not repay any plus loans made to parents, and last but not least, federal Perkins loans. So there are 3 types of loans that are not eligible for the PAYE program, and those include direct plus loans that were made to parents, direct consolidation loans that repaid plus loans made to parents, and FFEL plus loans that were made to parents. So essentially, if you had a plus loan that was made to parents, none of those loans would be eligible under this program. So the biggest question that you're probably asking yourself right now is, how much will you actually pay under the PAYE program? I'm going to put up an illustration of what the formula looks like on how you calculate what your payment would be under the PAYE plan. So like I said before, you would take your AGI, you would subtract the federal poverty line times 150%. Then you're going to multiply that balance by 10%, which is the amount of your discretionary income that the PAYE program requires you to pay. Then you're going to take that result and divide it by 12 to get what your monthly payment is. So let's go through a real world example of what that actually looks like, because I know this is a little bit confusing, so let's just walk through it. So in order to calculate what you would need to pay every month, you would need to gather your AGI, you need to find out what the federal poverty line is for your state, and last but not least, you would need to know that this particular loan is calculated based on 10% of your discretionary income. So now we're going to take a look at what the federal poverty line is. And I'm going to warn you in advance that these numbers are super low, so just be forewarned. Here is what the federal poverty line is. So as you can see in this chart, the federal poverty line is considered for a single individual as $12,760. So no idea how the federal government assumes that anyone can survive on that amount, but that is beside the point. For the purposes of calculating your discretionary income, that is the number that you have to use. Now, that is the case in every single state except for Alaska and Hawaii. So if you live in Alaska or Hawaii, you're going to need to reference your own state's guidelines for what the poverty line would be. This chart breaks down your poverty line based on your household size. So it goes from 1 to 8, and if you have a household with more than 8 people, then you would just add $4,480 for each additional person. So let's get into an example of how this works out, because I know I'm throwing a lot of math at you and that can get super confusing, but I promise it's a lot simpler than it seems. And to do that, we're going to make the following assumptions. First of all, we're going to say that you are single and that your family size is 1. We're going to say that you live in one of the lower 48 states of the United States. We're going to say that your current loan is $45,000 and it's at a 6% interest rate. We're going to set your AGI at $40,000. We're going to make the assumption that your salary increases at about 5% per year, which is, according to the U.S. Department of Education and the U.S. Department of Treasury analysis, about the average amount that someone with student loans will increase their salary over the course of 20-ish years, is about, on average, 5% per year. And because we assumed that you're single and your family size is 1, we're going to say that the federal poverty line for you is $12,760. So the first thing that you're going to do is take that federal poverty line number and multiply it by 150%, which will give you $19,140. Then you're going to subtract that amount from your AGI, which in this case, like we've said, is $40,000, which will give you a balance of $20,860. That is what is considered your discretionary income. Then we're going to multiply that amount by 10%, which will give you $2,086. So that $2,086 would be the total amount for the year that you would be obligated to pay. So we're going to take that amount and divide it by 12, which will give us the balance of $173.83. And that number is what you would pay on a monthly basis, which when you compare it to your standard loan would be significantly less, because that standard loan would come in at $500 a month. So comparatively, it's a lot less and it's saving you a lot of money every single month. Now, under the PAYE program, your payment isn't always going to be that $173.83. It's going to change over time. Your payment will increase as your income increases so that it's always within that ratio of affordability for you. So let's take a look under those same circumstances that we just talked about what that kind of looks like. So your first payment, like we said, would be $173.83, and your last payment, because it's capped at that rate that your standard loan would be at, is $500. That means that over the course of time, your income has grown at that 5% rate that we talked about, and so now you have reached the cap, which is that $500 a month. And that's what your last payment would be. So the time that it would take to repay your loan would be the full 20 years. And during that time, your total payments would be $81,706. Now that would not actually be enough to pay off the original balance because of the interest that would accrue over time. And so because of that, you would actually have a forgiven amount under this scenario. And that amount would be $7,703. So if we take that forgiven amount and assume that you're in a tax bracket where you pay 25% of your income in income tax, so you would be paying $1,925.75 in taxes that year, which would bring your total amount paid on this loan to $83,631.75. Now, if you want a really good shortcut on how to calculate your monthly payment for your scenario, your specific scenario, then I would highly suggest that you go to the loan calculator that is offered by the Federal Student Aid Program, and I will put that link in the description below. That will allow you to enter your own personal criteria. It will allow you to enter your exact loan amounts, and it'll spit out the scenarios on all of the different IDR loans of what you might expect to pay. So what else do you need to know about this pay loan? The big thing that you have to remember is that you need to recertify this loan every year. And whoever your loan servicer is, they're going to reach out to you to remind you to recertify every single year. But it's something you absolutely have to do. And that's because if you don't do it, you'll be subject to certain penalties, which I'll get into in a minute. But one thing I want you to know before we talk about penalties is that if your circumstances change in your life, say you get married, well, that means that you have an extra dependent. And so potentially your loan amount might be a little bit lower. And if that happens, well, then you can contact your loan servicer at any time, the moment it happens, to get a recalculated amount of what your payment should be. So make sure you take advantage of that if your circumstances change. So let's talk about penalties. So if you fail to recertify on an annual basis, the first thing that will happen is that your payment amount will shoot up to what it would have been under your standard repayment plan. So under our scenario, instead of paying that $173.83 a month, you would be paying $500 a month. Second, your interest that you had accrued over the previous year would be capitalized, which means that any unpaid interest would be added to the total amount of your balance. So if you had that $45,000 loan and just for, back of the math calculations, you had $5,000 in unpaid interest that year. Well, your new loan balance would be $5,000, and the amount of interest that you accrue next year would be based on $50,000 instead of $45,000. That's what it means when your loan capitalizes. And we definitely don't want that to happen, so be sure to recertify every single year. Another penalty that could be assessed under this plan is that your loan servicer would revert your family size back to 1. So if you're married or if you have kids and you were calculating your dependents and your loan amount based on your total amount of dependents, well, that's going to shoot right back to 1 as though you're single, and it's going to increase the amount that you would have to pay every single month. So all in all, I think we can agree that the PAYE program is actually a pretty great option if you're looking at reducing the amount of your student loan payments every month. The term of the loan is only 20 years, and it's only calculated, your payment amount is only calculated on 10% of your discretionary income, which is the lowest amount of all of those income-driven repayment plans. So you might be asking yourself at this point, how do you get a PAYE loan? Well, it's super easy. All you have to do is reach out to your current loan servicer, and they will walk you through the steps that you need to qualify for the loan and get it set up for you. It's really, truly that easy to do. So hopefully that has answered your questions about what the Pay loan is all about. So if you have any additional questions about the Pay program, feel free to put them in the comments below, and I will take a look at them, and hopefully the rest of the financial community will take a look at them, and we'll see what we can do our best to find you an answer. And if you're looking at how you can best pay off any debt that you have, I do have a tool that could be really helpful for you. It's called a debt payoff tracker, and you can download it for free at the link that I'm going to put in the description below. And basically what it does is it lets you lay out all of your debts and helps you prioritize which ones you need to pay off first and how much money you should be paying on each of those loans in order to decrease your total payoff time and get your loans paid off so that you can be completely debt-free. Because as we know, being debt-free really helps you boost whatever other financial goals you have in your life. And that's something that I want to be here to help you with, is meeting those financial goals. So if this video was helpful for you, then please be sure to check out some of my other videos, because that's what I talk about all the time, is personal finance, investing, debt payoff. All of those things are the things that you can find on this channel. And I would love to have you around for the journey and help you in any way that I possibly can. That's all for now. I hope you have a wonderful week, and I will see you next week. Bye-bye.